Can you please maybe give a little bit insights or what you do on your daily job as VP of credit unions? What does it really mean?
Yeah, so for Mambu, my responsibilities really are working with credit unions, primarily in North America, but also globally, on their modernization and digitization strategies. But prior to that, I've actually spent my entire career working for credit unions, either inside credit unions for 16 years or through credit union partners via other core banking platforms for another 12. So this has certainly been a lifelong journey for me in terms of working with credit unions to enable them to provide services to their community, create financial equity and financial inclusion to the members of their community by way of their technology choices.
That's great. And maybe that's a first takeaway that I'm doing. If you would like to be great at something, keep it doing more for than 15 years. That's maybe the case here.
Amber, can you please tell us more? What are the most important things you at credit unions are doing for the communities, for development, for and how this is linked to the digitalization of everything what is banking and fintech, and how digitalization is helping communities. Maybe it's helping communities to have more access, to have accessibility to the funds, maybe, or maybe to better services. Mm-hmm. Can you please a little bit describe your job here?
Credit unions were founded, many decades ago at this point to serve underserved communities, meaning people who were not necessarily able to access traditional banking services for varying reasons, whether that was geographic location, whether that was the type of job they were in or socioeconomic position within their communities. Credit unions were solutions that were founded to reach those particular parties. And that has remained true. Although they've evolved in many ways since their origination, they've stayed very true to their mission to serving the underserved and reaching those that don't have access to traditional financial services for the purpose of creating financial education, financial health, financial equity and inclusion, and allowing everyone the ability to create generational wealth or at least comfort for their families as they go. How they've really evolved from that, how I kind of view that evolution, particularly through the lens of modernization and digitization of your services, is the ability to expand the reach. No longer are consumers willing, realistically, to come into brick and mortar locations for all of their services. They are demanding that those services be available to them through their mobile devices, through their PCs at a minimum, and things like that. So how credit unions have really needed to consider what their future state looks like in order for them to continue serving those underserved communities is really now in how do we create access points for them. And in order to do that, you really have to consider being digital first and expanding your footprint in that regards.
And I was always wondering, when we're talking about credit unions, it feels like a supply demand issue. When we take a look on the financial services, like the digital bank, usually, and if they build their scale, they in other countries like United Kingdom, they started with MEI, which is not allowing to do the credits and deposits. Which, in contrary, with the credit union, you are starting with the lending and collecting the funds. How you would describe the difference in positioning? Because is it really the marketplace which is combining, or the community who's giving the money driving the strategy, or vice versa? We have a specific market that we know they're looking for the credits as local community, then we're building vice versa, from the local community to all the lenders that can be across different even states.
I think for the credit unions, those are equal. You're right that they're very intertwined. In that cooperative model, you can't just be a depositor and you can't just be a lender, right? They're working in conjunction with one another. In order to pay dividends to your depositor, you have to have a borrower willing to pay interest. In order to have money to make a loan to that borrower, you have to have a depositor. So in that regards, I think that certainly supply and demand are going to be an important element. And that is where credit unions, I think, have really leaned into how to make that as beneficial as possible to the community, to make them want to be part of that cooperative model. And that's really where the genesis of how they manage their interest rate, their dividend payment rates, and how competitive they are in those markets really is going to drive that, right? Credit unions historically are known for paying higher rates on your depository accounts, with the same type of protections that you're going to get through federal insurance funds. They're also very, very much known for being lenders that offer much lower interest rates to the borrowing side of the house. So, as an example, the most current rate for an auto loan in the consumer banking world is about 7.4%. In the credit union world, it's about 5.6%. So as a borrower, I'm much more inclined to want to go to a credit union to take out that loan. On the flip side, for the depositor, if I can get 3% on a certificate of deposit over 2.3%, then of course I'm also going to want to place my depository money there. So there's risk and reward to that in exchange for allowing us to loan out your money to that borrower that doesn't have it. We're agreeing to pay you back a higher rate, but we're not overly punishing the borrower either. So it really is communal in its approach in terms of looking for the best case scenario for both. It'd be really easy to charge the borrower a lot of money, right? And then the depositor, of course, sees that as an investment opportunity. In this case, you're really looking for consumers who are interested in being part of that ecosystem to some degree themselves, and they're willing to maybe take a little trade-off of not getting higher returns, but they also know that they're helping somebody buy their first home, or they're helping somebody have a vehicle that helps get them to work. Those are all things that align really, really well philosophically, particularly with younger generation consumers, that they want to have purpose and they want to have meaning behind their business relationships. And credit unions are really, really purpose-built for that, have been for a long time.
In this case, it sounds like a fintech is always driven by the fin, but not the tech. Like a financial incentive is driving this business model and providing better rates and better serving to the end clients from both sides. It actually is working really well.
You mentioned a lot about community. You mentioned a lot about the fact that exists a competition advantage in front of the big banks because of interest rates and so on. But what are the things that credit unions can teach big banks, besides the fact that they can offer better rates for borrowers and for those who are taking a credit?
I think credit unions are also really good at taking chances on those that maybe wouldn't traditionally be seen as viable customers for a bank, right? And that could be somebody who's suffered from financial challenges, maybe doesn't have the greatest credit report, maybe has had some unfortunate job history or things like that, or suffered, in some cases, even incarceration, right? There are credit unions that specialize in working with previously incarcerated members of their community to rebuild their financial health and get them foothold up, right, into reintegrating into day-to-day society. I think where credit unions really shine is in that perspective, is that they aren't necessarily putting each consumer into this really defined box. That if you don't meet those criteria, you therefore cannot do business with that particular institution. And now you are locked out of the financial ecosystem. Today's world doesn't work where you can be locked out of the financial ecosystem and really survive, let alone thrive, in at least in the United States. So I think credit unions are really good at leading the way and showing how those can still be viable relationships and mutually beneficial relationships, not just to the consumer, but also to the financial institution, in terms of long-term loyalty, increased usage of products and services, that depositor becomes a lender someday and vice versa. I think that's where all financial services can really learn from the credit union model.
Everything I hear is a mix of embedded finance and members first culture, where you combine both sides for providing a sense, giving a social aspect of a business or social aspect of investment as an individual, which is very, very, very great and nice to see that still exist such things in our age.
For several episodes, we are talking about digital banking, and the topic that we're discovering is lack of empathy. Because the more digital product comes into the market, the more it feels like machines are providing the service rather than the business with a human touch. And that's a shift from branches, because we used to talk with the people who were putting a lot of efforts into educating and suggesting how to run through the specific financial decisions, which with the computer, yeah, we have AI, but does it really know my background and what I expect? So that's a really interesting touch, which is happening across different business models. And credit union seems to be the one who is solving this really well, because they have this customer-centric approach. I will shift you a little bit away from a business model, which is really great, and understanding that it based on the pillar of customer-centric approach. How digitalization feels in this case? Because if we talk about neobanks, they usually start them from the ground. I don't have a history, and building something from the scratch is easy, because you don't need to have a lot of constraints, and you can build whatever you want without taking a look on your business structure, on your existing processes. Is it the same case with the community banks? Are they more driving the technology by starting new business, or more of the cases like, okay, we have something and we have to replace it?
Both. So you're hitting into like the crux of the problem for credit unions and community banks realistically, in that there is an existing customer base that has to be worked with, right? And that same customer base has the same expectations for digital experiences as someone new that you're acquiring to the business. So when you're thinking about an established financial institution and what that means to be digital first or go through a digital transformation, you need to actually approach both of those problems. And how do you want to solve them? And there's a couple ways to do that. In the credit union space, traditionally, that has unfortunately meant a complete lift and shift of your infrastructure to a completely new core system, maybe a completely new digital banking system, but you're really, your payments, everything is really getting ripped out and done at the same time, which makes those very, very high risk. And because of the risk of those, the scale of those projects and the risk of, data loss, data corruption, interruption to services, loss of trust by your consumers, many credit unions and community banks have decided not to do that. And that's where they're running into the competition from neobanks, digital banks, and fintechs, taking their consumer base away from them, is because they're working in a lot of legacy architecture. They aren't able to offer the same types of digital experiences as the ground up parties were, right? So they're getting beat on experience. They aren't necessarily getting beat on mission. They aren't necessarily getting beat on purpose and what they're doing for the overall socioeconomic position of their communities, but they are getting beat on convenience and they are getting beat on automation. And so this has been a friction point for quite some time. I think what's beautiful about our current state of technology now is that the idea of composability, systems that are built to be API first and truly cloud native, are changing that landscape for them. Where no longer do they have to actually consider the lift and shift approach to deal with their existing membership base and then hope that they can pick up new business lines with whatever the new version of the software that they're going to, the ecosystem that they're going to be working with lives on. But they can approach both of those problems in two different ways. While they take themselves through a migration and a digital transformation of the existing legacy services and legacy consumer base, they can also launch more of composable cloud cores as a speedboat and capture the new business and start to build their digital journey from the ground up like a neobank would or like a digital bank would, without the interruption to the existing member base. And then over time, migrate the existing members as there's some sort of event or trigger that warrants the new services for them. They can then control that at their own pace. They can de-risk that transition without having to move. If you're a credit union with 400,000 members, you don't want to shut down for a weekend and interrupt 400,000 members worth of services, right? That's very terrifying. But if you can do that in chunks where maybe you move 20,000 of them that happen to have a need for your new tech stack or your new product, then you get to de-risk journey for yourself. Those are not things that have been available within the credit union space to this point. So there really is, I think, we've come to a space where our mission and our technology can match now, and we can actually accelerate the growth and reach of credit unions by way of their digitization strategy.
Based on everything you said, I just like to thought about, like, in 10 years, credit unions will become fintech or neobanks, or more like a neobank. Or in 10 years, maybe neobanks will become more like a credit unions because they'll understand that a social paradigm, a social need investment will be a must. Because sooner or later, credit unions, because basically you have resources, you have time, you know your customer, you have embedded finance from both sides. You sooner or later will have all these digital assets. You'll have these digital tools for, being very clear to anyone in the East Coast or West Coast or in Europe even, without being present physically there. So I still have no clear vision, no clear understanding till the end. In 10 years, it will be, neobanks will be more like a credit unions, or credit unions will transform into neobanks.
Well, my hope is that credit unions become a little bit more like the neobanks, and for a couple of reasons. One, credit unions are a very trusted institution. So although the model is maybe what's considered the business model, maybe is considered a little bit legacy compared to what we see with the neobanks, there is still a very high level of consumer trust with credit unions. Credit unions have proven for decades that they are very responsible stewards of money. I'll use a great example. In 2008, in the United States, we suffered some pretty significant economic impacts that required big banks to be bailed out by our federal government. Credit unions did not take one penny of bailout money, and not one credit union was closed due to risky practices similar to what some of the banking industry was doing. So you have the high level of trust in terms of that they operate their businesses in a way that make good sense from a safety and soundness perspective. They have a high level of trust in that they've always committed to provide for the consumer first versus the bottom line in a profit-oriented environment. And they still have the backing of the insured funds that a lot of neobanks may or may not have, depending on their licensing structure, so that in the event that something unexpected happens, consumers can trust that their money is protected and it doesn't just go away and disappear. I do believe it is a renaissance period for credit unions, that if credit unions can meet the digital experiences consumers are expecting to have, that everything else that they've proven to be so good at for so many decades will shine through. And I think you see neobanks trying to replicate that in some regards already, with targeting niche markets or looking for segments of communities that have similar interests and things like that and targeting them. They're already kind of behaving in a credit union way, so to speak.
Yeah, that's true. And I see like a gray areas emergent between different financial institutions, because that's not even the question of the neobanks and the credit unions. I see the rise, at least on the Middle East in European countries, the rise of buy now, pay later model, which is not the credit union or a digital bank like by nature. And that's a question that I would like to ask. My understanding that buy now pay later is driven by the younger generation, because some complex business models, they are not up to their vision. Like, I need to build a long-term relationship by being a Gen Z who is not really in the visibility what they're going to do in 10 years or more. Is there the risk, and maybe from the financial perspective, but also from the product perspective, how they keeping up with the needs of different generations? Because it's definitely proven from baby boomers or Gen X that it's a stable and required financial model that we will interact with. But how the adaptation for other generations happening?
You are hitting another pain point that exists in the digitization journey. A primary reason that a lot of traditional financial institutions haven't been able to capture that type of business is because their architecture doesn't allow them to. The core systems, particularly that they're using, don't have a product mechanism that would support a buy now, pay later structure. So if you can't even set up the product in your core, how can you possibly try to embed that option into consumer facing sites or your members' wallets as a choice, right? You can't. So a lot of the financial innovation that has really come to pass over the last 10 years is, or even last 20, really, if I want to get really bold in calling out some core systems here, our innovation has been limited by the innovation of our core data processors. And the innovation of our core data processors has been very, very low, right? Many of those systems are 30 plus years old. They are batch based in the background. They are not API. They were not designed for today's world. This is where the fintechs saw a gap, right? That they stepped in and they filled a need for solutions that couldn't be found elsewhere. And that has left credit unions and traditional financial institutions trying to catch up. That is, again, where I think there's such a point of resurgence available to the credit union and community banking sector with systems like Mambu that are designed to allow you to orchestrate what you need to be a buy now, pay later source. You can now create that product. You can orchestrate the rules that you need to, and then go ahead and embed that through the APIs. So your consumers aren't necessarily required now to rely on fintechs or non-insured neobanks to become those lenders of choice. Now, if you can couple that convenience with the credit union mission, where the buy now, pay later rates or terms are more favorable, you are now benefiting that consumer, right? As a Gen Z borrower, I have Gen Z children getting ready to come into the space. If they're going to work with a buy now, pay later vendor, I don't want them paying what is the equivalent of a 30% interest rate or 50% interest rate. I want them paying the equivalent of like a 10% interest rate if they're going to do that, right? And I think credit unions are more willing to step into that space if they are enabled by their technology to offer it. And that has been the crux where they've been held hostage, is they haven't been able to offer the products they want. Therefore, they have been held back from competing in these spaces.
But exists a lot of stereotypes and myths in credit unions / neobanks / current world / Gen Z. And one of the myths is that credit unions can't innovate fast. Is it true that credit union can't innovate fast, or things changed and innovation is just, knocking on the door, and it soon will be like a big splash and a big flash and everything will be like innovative and in credit unions?
I think that credit unions have a desire to innovate. And if you go into credit unions and look at how they operate their businesses, you'll find that they're quite creative in coming up with workarounds or ways to make things more efficient, despite some of their technology constraints. So the desire has always been there. I'll speak back again to the crux in my experience, 20 years working inside of credit unions with these legacy core systems as a buyer of the systems, and then working in core systems themselves as a provider. The crux has been on us because all of our logic and business logic is reliant on the core. So if we want to create a new product, we have to call them. We don't have the power to create it ourselves. So we have to get on their roadmap, get on their timeline. So if they're trying to clear tech debt, we got to wait behind that. If there are other financial institutions that have written a bigger check than we wrote, we have to wait behind that, right? And so what we find ourselves in is this space of having these really creative, innovative ideas for how we want to engage with our consumers by creating new features and products that now get stuck sitting on a shelf of 12, 24, 36 months, if ever, to actually get released. That has just been a constraint that we have had by having legacy end-to-end cores where everything is owned by them, right? We needed those 20 and 30 years ago. We didn't have the experience to do that ourselves. We didn't have the tools to do that ourselves. That has all changed. And now we do have the ability to have no-code orchestration and no-code, low-code integration tools that allow us to connect disparate systems together, where credit unions can now take a lot more ownership over their tech stack and therefore their product creation. So with the appropriate tools, I fully believe credit unions are innovative. They just haven't had the tool set necessary to allow them to do that. So this ability for us now to move to more composable banking architecture, to move to true digital first and API first systems, decouple all of this logic away from these legacy cores and into our own orchestration logic is going to be the dam that gets broken to allow credit unions to actually model the innovation that typically doesn't get seen fast enough because they've been held back.
Another myth is the fact that credit unions are not flexible. Everything you just said before this proves that it's flexible.
Yeah,
so let's jump to
that right out the window. Yeah,
let's jump to the third myth. Is that credit unions, and the last one, that credit unions are not so much engaged with Gen Z, with younger generation. Is it true or not?
That's true. It is true from the perspective of they have been, again, really beholden to these traditional core digital banking providers that don't have the digital experiences or the ability to allow them to build the ecosystem that creates the digital experience that Gen Z wants. Mm-hmm. That's a table stakes ask for a Gen Z provider. If you can't do everything from your phone, they're kind of at this point not interested, right? They love the idea of being able to go in and talk to someone if they need it, but they don't want that to be their requirement. And where credit unions have struggled with attracting those members has fully been leaned into the digital experiences that are there. Philosophically, mission-wise, they align perfectly. Gen Z would love to do business with a credit union, but they will not do it if it's going to take them 2 weeks to get their auto loan figured out, or if it's going to take them 10 days to set up a retirement account or things like that. But that's where that, again, friction point has come in, where those legacy systems have created a bit of a backlog, and now they are in a catch-up space. I mean, that's a true statement. Credit unions are in a bit of a catch-up space when it comes to Gen Z. They maybe didn't move fast enough 10 years ago, or from a regulatory perspective, they didn't feel like they were empowered enough maybe to move fast enough 10 years ago or 15 years ago. All of those markets have changed. I think the attitude towards technology has changed. The digital IQ of credit union leaders has increased exponentially. There are credit union executives who are being hired from outside of the credit union movement who are also helping to drive a lot of these transformations. And now the choices have broadened. Their options are broadened in ways that will truly enable them to be able to actually move faster and meet those needs. But you're not wrong, Dumitru, that's been a That's been the statement, the rumor, the feeling, the perception is that they don't care about Gen Z. And that's not necessarily the case. It's that they haven't had the right tool set to be able to track them.
And in this case, I will add, because I was listening about digitalization, I feel that the market is really fast forgetting like what was happening. Because if we have something today, we have a feeling that existed for a long time ago. Mm-hmm. And I still remember the times when the Wells Fargo released the application, and then you could not start the local payment for 2 years. So basically you have statement applications that just do nothing except log in and show you the balance. And maybe sometimes transactions, because you have to wait for a day or two to pop into the transaction list. So I think we are not anticipating that actually it's not just the question for credit unions, but all the traditional institutions which didn't come from the scratch into digital space. They have a lot of inertia, a lot of tech debt to cover to do the things which we think, okay, that's just a couple of months, you have application, you're working with that. And that brings me into the topic that I would like to dive deeper is you mentioned composable banking. And that's kind of wide term. And what does it really mean for you in space of credit unions? Like how you would describe and simplify it to everyone to understand what actually it means?
For me, how I would describe composable banking is that adopting a composable architecture strategy means you are taking ownership of every layer of your tech stack. So what I mean by say taking ownership of that is I'm now going to build out the tech stack that is purpose built for the services and features that I want to offer to my consumers. And that build out is also going to be easily interchangeable, meaning if something stops serving me, I can pull it out without an immense amount of disruption. There's a couple things that I think will come into play with that. That's sort of the overall theory around composable banking, but then how do you execute on composable banking and what does that mean? That does mean decoupling some of your tech stack, right? There are a lot of traditional financial institutions that are running the majority of their business in one piece of software, one monolithic piece of software that is, again, 30 years old, batch-based. Maybe it's got an API layer on top of it, but it's not every field, every feature, every function is not going to be available. So it's kind of bridged the gap between the Gen 1 cores to the Gen 3 cores. You have to decouple away from that, and meaning you need to start peeling those out into pieces, and those become your composable puzzle pieces where you can then click them together in the ways that make sense versus having everything living in that one monolith. All the logic is controlled in that monolith, and any changes to that monolith are typically going to be owned by the proprietary software owner, meaning your core data processor. Those are all the things that are going to create flexibility. So if you can take your architecture and say, all right, we're moving to digital first strategy. What does that mean for us? That means we need everything to be accessible by API 1. That means that we want things to be purpose built. We no longer want these end-to-end one vendor solves everything problem, because those haven't worked, right? They do everything okay. They do nothing great. We want to move away from that and pick the things that are truly great. We need those things to be interoperable by way of those APIs. And we're going to create an ecosystem that can talk to each other across every single one of those pieces, every single one of those composable banking pieces, where we are now orchestrating the journey as we would like it to be experienced by our staff and by our members. So it really, to me, is that decoupling first, then thinking about, okay, once we decouple, what are the requirements that we need? API first, cloud native, digital first architecture, rebuilding that in ways that you're picking the purpose-built partner, best of purpose partner, might be the best way to say that, and bringing those into the ecosystem. And then when you need to change it, it's a small piece instead of having to rip everything out to change one thing or pay double because you retire something in the legacy system. A great example of this is many core systems for credit unions have like a debt collections module within them. A lot of credit unions don't use them anymore because they're outdated. So now they're going and buying another system on top of that and using that. Well, now they're paying for the tech debt of two systems, because you still have to pay to maintain that core and the module, whether you're using it or not. So you can also really control your total cost of ownership over time by moving to a more composable model as well.
For me, it sounds like a little bit maybe from automotive, because you can build the best car, but as a prototype, and then you have 5-10 items. But it feels completely different in terms of the support and the cost of the support. If you, I don't know, producing 100,000 of the cars per year, and you need to supply with the like additional items, with the interchangeable stuff, with the supporting customer support, because the more you create, then the more cost goes down. and more easier is to support and fix something that you have in production. So I think it's kind of evolution of car maintenance. If you have something well adopted, well structured, and interchangeable on certain levels, then it's definitely going to serve better needs for the customer. That's really great insight. I really like. And it rings the bell because I hear the word decoupling a lot in engineering space, because always engineers like, let's decouple this task into smaller pieces. And I think it comes more into the business space when we understand that we need to build something more agile and flexible rather than closing the specific business needs on this moment. Because the life becomes so fast and the needs of the market become so changeable that we cannot project everything how we're going to do, but we can say, okay, we understand that it might not be perfect right now, but we would like to have a better updates and better control how it functions in the future. So it brings a little bit of the complexity, but gives much better business outcomes in the current context.
In a composable model and in a true digital first model, whereas a financial institution, you're taking on the autonomy and responsibility of setting business logic and setting feature requirements and feature sets, and then being able to control the changes of those. You can adapt, right? So what works today and what consumers want today is not the same thing as what consumers will want 2 years, in 5 years, in 10 years. And instead of being beholden to your software vendor to hopefully keep up with those things or respond to your request for those changes, you have the now authority and autonomy to take care of it yourself. So you can be significantly more nimble in those response rates to the consumer needs as you see them coming.
If you, for example, Amber, we have the possibility to whisper a piece of advice to every credit union CEOs, what it would be?
That's a hard one.
No, it's not that hard. It's a message I've been saying for a long time throughout my career, and that is break up with your legacy core vendors. You cannot innovate if you are still going to be beholden to those legacy cores. I understand the fear behind the change. I understand the cost behind that change, but the cost of inaction is going to be greater over time. And credit unions are already at a point where there is enough competition in the world that inaction is not a path to relevance, right? It is a path to slow death. So it really would be to break up with your legacy core system.
That sounds like a motto. And maybe the last question from my side, we're starting to do this practice, like, what is the question that we didn't ask today?
I think maybe one thing we didn't really touch on, we maybe hinted at it a little bit, but one of the things that we didn't touch on is over time, how does modernizing your core system and your tech stack beat out your legacy tech stack from a scalability perspective and like the total cost of ownership perspective? We sort of like danced on the edge of that, but we didn't necessarily dive into how costly it can be to maintain those legacy core systems, the tech debt that comes with them, the lost ROI from delayed innovation and launch of new products, overall the need to continue piling more and more fintech solutions on top of those legacy solutions to solve problems because they're not responsive. So over time, that cost is going to will be exorbitant. That scale gets really hard when you're working with a system that maybe wasn't even built to ingest APIs at a large volume, and now you need 100,000 of them a minute to be able to service your membership. Those things are all going to start to break, and those will be costly. So I think there's also really a valuable conversation to be had in the total cost of ownership in staying in legacy ecosystems and trying to Frankenstein your way out of them versus making the bold choice to maybe digitize and modernize from the ground up and set yourself up for a longer term, lower total cost of ownership and maintenance.
And I think like a financial planning and financial balancing in digitalization is corner topic, because from my perspective, I really like this experiment with the young kids when they were promised to have one cookie now, or if they wait for half an hour, they will have two cookies. And it's not so obvious that a lot of kids cannot actually think and project that, okay, I will wait, but I will get more. And something is happening, I think, on certain level with the decision making in big corporations, because sometimes not taking a bold decision and not taking the credibility. Okay, we'll make this decision and let's see what is happening in 2 years, 3 years. But the more time is approaching, the more you're in this loss aversion. Okay, we didn't invest. That is going to be harder. That's why I need to continue. And not taking decisions is really hard topic, which is really connected to the financial education and control over the delivery and budgets. So it sounds like a full episode for me. Maybe if you will have possibility to discuss this deeper as a next episode when it works for you, it would be really good, because I'm really interested in this aspect, because serving the specific needs, but having all the instruments for financial planning and working with the technology risks, sometimes for the people who didn't come from the technology's perspective, is really hard.